Here's a short video to explain the example given this week about a company's decision to either reinvest or pay dividends with profits. It should help you understand the dividend valuation models of zero growth and constant growth, as well as the calculation of growth. Now here's a visual representation of some of the decisions a company might have with leftover profits. It shows free cash flow here. However, you will find out next week that free cash flow is money left over for all investors, including debt or bond holders. Therefore, some must be paid out for bond interest payments. Now, I'm only going to concentrate on investing or paying dividends. In addition, read this week's content to understand the important dates in dividend payout. Now, here's another visual representation using two financial statements. Now, equity and debt or liabilities are used, which is actually a company's capital structure, to purchase assets. Now, these assets generate revenues minus expenses equal profits. Now, profits can be reinvested to grow a company or paid out as dividends. Now, here's your problem from this week's content. The equation here is showing a zero growth valuation, like perhaps a preferred stock. All the dividends are paid out, leaving $0 to be reinvested. Therefore, the company cannot grow. The firm decides to retain 25% or $1 of the original $4 dividends. Now we look at this equation here. This is the constant growth model. The new dividends will be 75% of the original $4 or $3. The $1 is retained to be invested in an idea with a 12% return. Now this 12% could also be considered return on equity or ROE. Now if I multiply ROE times retention rate, or 25% times 12%, it equals 3%, which is growth. Now plug it into the constant growth model and the new price of the equity is $42.86. As long as the ROE is greater than the RS, the stock will rise. Now, however, look here and you'll see if the retained earnings are invested at 8%, which is less than the RS's 10%, the stock will drop. In the real world, investment decisions are calculated as net present values using this equation here. The predicted ROE or our predicted return on investments for net present value calculations is closer to 30%.